with this question of the day, does this give us any, I suppose, further conviction whether, is the inflation transitory? Is it just reflation? Is it an ongoing theme that markets are rightfully backing? Does it give us any more information on that?
I think the development on Friday doesn't really tell us very much about that. But I think what the commodity prices and the input prices are really telling us is that inflation, short term at least, is going to have some very scary numbers. We're going to be, for example, this week's number in the US, we're looking at something like 3.6%. And I think what the market's got to start doing is at least pricing in some probability into the bond market that perhaps this inflation is not as transitory. But at the moment, I think the view is very much that the inflation is transitory. We think it's going to last at least until the end of the year, so staying above the Fed's target until the end of the year. And then once they start withdrawing the stimulus, then we'll actually see, as the tide is going out, that the inflation number hasn't really changed very much. So I think the Fed, having experimented for the last 10 years, is trying to keep on running it hot. But I think at the end of the day, the disinflationary forces are still very strong in the economy. And I think what we have to do to reverse the sort of 30-year trend down in inflation is to reverse some of the things that have actually caused that disinflation. And I don't think we're anywhere close to doing that.
Mo, are we seeing a bit of a gap developing now? Because for so long in this pandemic, it's about Asia pulling ahead with the recovery, with the management of the virus. Now we're seeing some of the worst outbreaks and, third subsequent waves in this part of the world, while the US and UK are showing clear signs of recovery. Does that change asset allocation preferences now?
Well, I think from a mechanical perspective, when you look at the upside risk-reward arguments, yes, it does. But I think what it doesn't take into account, Asia has actually underperformed by about 15% since the middle of February. I think there's two key drivers to that. The first is, obviously, in China, they've moved from a loosening bias to a tightening bias and then warned about bubbles in asset markets and in equity markets. And even though regulators were warning about that overseas, the Chinese market took it very much to heart. And the bubble that was building up short term in Hong Kong tech names, that seems to have burst. And now we're at very interesting levels, we think, even this morning, where basically this market needs to hold to prevent another 14% downside. And we think that the state funds are active there. So that's the first driver. And this is probably something that's going to be a theme that's going to happen in the US and the UK next year, perhaps in Australia later this year, if the RBA does decide to move on yield curve control in July. But I think that's very much one theme, is that the PBOC has been shrinking its balance sheet while the Fed and the other central banks have been expanding their balance sheet. And that explains that. I think the second thing...
Oh, go ahead, sorry.
I think the second thing is really the reaction to the virus. So the reaction to the virus across Asia has been anything from incompetent to sluggish to autocratic to complacent. And you can, take your favorite countries and you can sort of put them into one of those four brackets. And until we get a better hold on vaccinations and a schedule to reopen the economy, in Korea, at the pace that they're going right now, I think I read that they're going to take them 1.7 years to reopen.
Well, Mo, I'd like to jump in here for a couple of reasons. First of all, it's ironic to me. The U.S. was criticized for its response to the virus, and yet it's leading the world with vaccines now, it seems, right? Producing them, getting the vaccines are just rolling out like crazy. And another irony is that all those stimulus checks have helped fuel China's recovery, Asia's recovery. You look at the latest U.S. trade deficit, half of that big deficit is with China now. That's what those $1,400 checks have done, is buy a lot of stuff from overseas. So when you look at Asia, how important is it that more U.S. fiscal stimulus comes to help Asia keep afloat, especially the countries hit hard by the virus, and move ahead once they finally can get this whole vaccine process, reopening, et cetera, in place?
Well, I think ironically, we're in this very strange situation where in the US, bad economic data is actually good for the equity market because it means that the Fed's going to continue with its stimulus for longer, which means the equity market will go higher. And I think over in this region as well, if we get bad economic data over here, particularly for China, what we're waiting for is some sort of catalyst that says that China, the PBOC is prepared to loosen policy. What's interesting at the moment is that as China continues to tighten policy, and inflation in China is only running at 1% here, and real rates are positive. What is interesting is that the three-month forward on rates continues to trend down with the equity market. And so we think that if the equity market falls here, you could actually see a very significant change in the way that the PBOC is actually approaching the economic environment. So I think the stimulus checks are certainly fueling the recovery, but that's not really translating into equity prices as such.